Good afternoon. Welcome to the TheoTRADE afternoon video. I'm Blake Young. Today is August 8th, 2024, and we're going to talk about defensive stocks and the VIX not sounding the all clear. To start out with, we will start out with the ES. You can see the ES had a pretty solid recovery today. We saw Thursday's price action climb. We saw about 150 points from the low in the overnight all the way up to close near the highs. But there's a couple things that we need to be looking at in addition to just simply a very large bullish day. And that is, one, we did not break through this high. Two, we have certainly not erased any of this, at least sizably, the sell-off that we had over the last week. And so this is simply a retest of the previous highs. I've got to get through that previous high. And the monkey bars that are showing us the distribution for the month of August is really showing us that we are facing a overbought zone near the 5400. But there's more, even more than that. So let's go look at the sectors that are supposed to be defensive sectors. If we're not in defense mode, they should be able to fade back. They should actually be able to close lower, and we'd see a flight away from the defensive stocks into the tech stocks and a lot more rallies across the board. But that's not what happened. Instead, what we saw was a maintained super high in things like consumer staples. Consumer staples have been in an uptrend for a while now, and we had a pullback there in April, but we've continued to push higher. And while everything else sold off 3, 5, 8, 10, 15% off the highs, consumer staples has maintained over the last month near its highs, within a matter of 1% of its highs as of today. And so we're really seeing this maintaining strength in the sector that is kind of seen as the defense sector. We're not really seeing a move away from defensive plays into consumer staples. We take a look at XLU, utilities. Utilities, you can see, held up here. Yes, there's some consolidation, but we're consolidating above the previous 52-week high. Utilities also have a tendency to act as a substitute for bonds. If we're not wanting to buy into bonds, then we can get a good dividend as a dividend yield or return, similar to the way we look for an interest rate on bonds. So bond yields and interest rate or dividend yields can help you hedge risk while still maintaining some sort of return on that risk. Now, taking a look at healthcare. Healthcare has been all over the board with the different stocks. There's some that are in the insurance world, some obviously that are more in biotech. And even with that being the case, and even with the big sell-off, you'll note that it's also come back from its lows. This is 7% here, and is only down 2.5% from its all-time high. Now, we're not getting anywhere close to that on things like the tech sector. The tech sectors, we'll use XLK, which had the best day today, was up 3.73%. But you can see we are still so far off of the highs that this is just a bounce and a recovery within this, and it may even be a dead cat bounce. We're not seeing money move away from consumer staples, healthcare, and utilities into the tech sector, despite the fact the tech sector is super strong. And so it's not a rotation of money out of the defensive sectors into technology. It seems like a dead cat bounce, a slight recovery off of the lows after technology fell from 238 all the way to 190 from peak to trough down here. You're seeing that we corrected 20%. Now, most analysts and most technicians will tell you if you close below that 20%, you are in a bear market. Technology was almost in a bear market. It went down and just tagged that 20%. The recovery off the lows looks phenomenal. The rally today being up 3.73% is great. But in the big picture, even from the high to today, after that big rally, we're still down 13%. We have not cleared this high or this high, which was the gap day. And so we have a barrier at 206, and technology is not rallying. Let's go check the VIX. Now, there's lots of ways to look at the VIX. I've always looked at the values as you see them marked on this chart. I think if you're ever below about 12, that is so low, you should always be buying options in those cases. And from that to about 13, again, generally looking to be buying and maybe into verticals and other type of trades. From 14 to about 22, for me, that is an actionable area. That there's volatility enough to sell options, buy options, do whatever you need to do or want to do. But it's not so crazy that you can't hedge and manage risk. When you get above that 22, 25 area and it goes all the way up to 65, that is panic. That is where people can't really control the chart, they can't control their risk, and it's harder to manage. We've pulled back to this, but notice that we're still holding above that key area. So the way I read this in the VIX, my levels that I've had here for quite some time, this test of this previous line is not necessarily resistance and support. I don't treat it the same way. It's just a key level. Anything above about 22 for me is harder to manage the risk, harder to manage the volatility. And if you don't think it's harder to manage the risk and volatility in a market like this, you probably haven't been trading for the last 4 days. But when it's over that 22, it's not that it's not doable, but it's harder to manage. And while we're above here, this is ready to turn back up. It would need to close back below that 22 before I think that the market is calming down and we can manage our trades in a normal fashion. But a bounce here at 22, a return to 35 or higher would tell me that we are still in panic mode, that we're still looking to exit positions, if not take bearish positions on some of these markets like technology. And if we look at the ES, you can see similar. We have not cleared the gap. That gap has not been cleared, and we're not 20% off the highs. We're a lot less through here. Take a look at the Russell. We'll use the RTY for the Russell. And the Russell also has not filled its gap. It's also just testing the previous trend support line as potential resistance. I don't think the all clear has been sounded. I don't think we're able to go back in the water. The water's fine. This is possibly not just Jaws, but the mega. The Meg is under the water waiting and lurking. So I don't think we have the all clear. I see that we're still in defensive mode. The money has not rushed into tech and growth and expansion. It's maintaining in the defensive areas, and we've only bounced a fraction off of those lows. Less than 30% of the sell-off has been recovered, and volatility remains high. And I think part of it was kind of a misunderstanding, or maybe a hope that with the bond auctions in the 10-year and the 30-year that we saw a lower rate and maintained demand. Actually, the 10-year didn't have the same demand. We had 2.3 bids for the highest rate versus 2.6 before. But we had the same demand for the 30-year bonds at a lower interest rate. So that's pricing in lower interest rates but higher prices. So theoretically, we should see money return back into those bonds if that's what we're seeing in this auction and going forward. If we see that continue, bond prices will go higher. Yields, even though they're sliding, that's going to be a warning to us. And I'm not convinced, again, that we're going to push higher. Add to that the fact that weekly unemployment claims, this is new weekly unemployment claims, came in better than expected, but lower than the previous time. If you look at the chart, this is still high. This means lots of new people are filing for unemployment benefits. You can see the trend. You can see the pattern in unemployment. As you're looking at the unemployment trend and looking at the lines here, the charts, if we were to look at this from the perspective of this trend, I don't think there's much question that we're making higher highs, higher lows. We are trending up as far as new weekly unemployment claims. So this is not people that already are on unemployment. This is a more cumulative effect. We could add this week to this week to this week to this week and only subtract people that got new jobs. And so this is an uptrend. It is climbing. So yes, it's down from the previous. It's looks like it's down from the expectations, but the overall trend is still rising. The employment situation is not improving, and I don't think that justifies the excitement and the rally that we're seeing in the market. So I'm watching very specifically not to go bearish into equities necessarily, but to be bullish in those areas that maintain bullishness, so that if we get more defensive, more fearful, we should be looking at consumer staples, utilities, and health. On Monday, I sent out an email and alert letting you know that I liked Costco on Monday. Where was Costco on Monday? It was back here at 800. I said I like it at 800. This is where we think it's going to go. We've made a higher close, slightly lower close, higher close, and it's recovered 5% in 3 days. Costco is one that maintains and has a lot of strength, has the tendency to endure and actually thrive even during times of uncertainty and during economic turndowns, because they're very careful and they're very strategic in avoiding layoffs and avoiding really high-end stuff, high-cost stuff, and moving towards the things that everybody needs. And so they have a really good business model, and they have a tendency to do well in all economies. But in conjunction with that, I would still be watching for things in Walmart as well. I'd be watching for things in Procter & Gamble. I would continue to watch for things in personal care products like Kenvue and tobacco products like Philip Morris and Altria. But as you can see, Walmart gave us a nice little bounce today. We do need to be careful with earnings, but it gave a nice little bounce today, up 1.12%. Not nearly the pullback that we saw in technology, and so the upside and rally potential is still large there. Look at Procter & Gamble, record high close. Even though we didn't put a new high shadow in there, Procter & Gamble is still very bullish and pushing up to the new highs. Take a look at Philip Morris, which I've talked about in the previous weeks as well. Philip Morris pulled back a very small percentage, bounced up, and is recovering. And so this looks very promising to me on the upside as well. I mentioned Kenvue, but it's primarily being driven by earnings. Came in as expected, or basically the same as it did last quarter, but that outperformed what the analysts had priced in, so it pushed all the way up to 21.24. I'm not going to chase this one, but personal beauty products could be something to pay attention to as well. In the TheoTRADE main room, I did talk about utilities today, and my favorites remain Nextera, Duke, Dominion, Southern, and even Vistra is an interesting one for me, and Excel. And you can see holding up near the highs, consolidating, still a bullish candle in Nextera. Remember, you get a good dividend yield in this as well. The premiums are decent on the put options, selling puts to get in. Duke's holding its own here. And generally, we would expect a big sell-off here. We're not really seeing the sell-off. We're just seeing maintaining and holding in Southern and Duke and Dominion. And so we're just kind of holding at the lower end of this consolidation. It might be worth taking any number of these trades at their lows with a relatively tight stop loss, knowing that you're protecting it and being in the position that will pay you a dividend, as well as potentially gaining back to previous highs, like Vistra pushing back to 95, if not all the way up to 107. Vistra has already gone through its earnings this morning and showed that there's still some strength, but rounded out a low here. If you want to wait till it clears 83. I still think 95 is a good target for Vistra. I do think there's some very attractive things in healthcare, like ISRG, Eli Lilly, Danaher, Thermo Fisher. They are still holding up, still doing very, very well, pushing up to these previous highs. Thermo Fisher and Danaher pulled back to give you a better entry price potentially, and there's still upside potential for both of those. TMO's bounced off of 590. I would expect it to go back to 620, if not new highs. Danaher is similar. We saw it pull back and retest its support level. If we look at its support level, call that near 263. It's an inside day, but a very large bullish day. If it clears 271, I think you go to 281, if not higher. And things like AbbVie and Amgen, I feel like they've already given you the bounce and the confirmation, pushing up to new record highs. Again, 190, easily the highest close that we've had in the year, and we're pushing towards record highs. AbbVie and Amgen, last one that we'll look at today. Amgen bounced off here, recovered, cleared the high after a down move in the earnings, and we've gone right back in. And so you have a gap to fill at 328, a target at 340, and then from there, the sky's the limit. We could go back to growing at a rate of about 10 to 15% every quarter and be looking at 30, 50, 60% by the end of the year. Well, that's going to do it for me today. Join me again tomorrow with Brandon. We'll be talking a lot about this. We'll even get into some information about junk bonds and interest rates as we're watching the market, trying to decide where it's going to go. We'll see you in the morning and talk to you soon.